What's ahead for our property markets in 2022? Already there are some wild predictions, both positive and negative, if you look at the media. So in this week's Property Insider video, Dr. Andrew Wilson and I discuss the multiple factors that are going to affect our property markets and share with you some trends and forecasts. If you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so we can let you know each time a new show comes out. We experienced a wild ride in 2021, didn't we? No one would have predicted the astonishing property price rises we enjoyed across the country. So what's ahead for our housing markets in 2022? Well, we're only a short way into the year and already there are some wild predictions. Just look at the news headlines and you'll see both positive and negative forecasts appear in the same media outlet on the same day. They vary from Omicron variant of coronavirus causing our economy and our property markets to crash, to a sharp decline in the jobless rates, which is now going to cause official interest rates to rise significantly sooner than the RBA planned, and that's going to slow down the economy. So I'm looking forward to my first Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, to get his thoughts on the trends that are going to shape our property markets this year. Hi, Andrew.
Yes, hello, Michael, and Happy New Year to you. And
yes.
They typically call this time of the year the silly season, but I think the silly season now goes on and on and on, really. And the headlines, of course, of the last week or so validate that, as we've had a lot of nonsensical headlines last year and the year before. But the same old suspects keep popping their heads up. They keep getting it wrong, but they keep getting reported. Go figure.
Well, maybe that should be the first prediction we make for 2022, that that's not going to change. But before we get into the predictions, the trends, Andrew, I'd like to chat about the elephant in the room. The latest ABS figures showed a sharp decline in the national jobless rate, and this has predictably resulted in another wave of speculation suggesting official interest rates may rise sooner rather than the RBA's current outlook.
Well, you could just about set your watch by it, couldn't you, Michael? If we do get a lower unemployment rate, the bulls are often running in terms of hawkish predictions of higher interest rates. I see a number of banks now are predicting August as a likely move by the Reserve Bank to increase interest rates. I think that is absolutely nonsensical, and I can tell you why. Now, there's no doubt that there were some very good numbers in terms of the unemployment rate. We had the December numbers, which finally, I guess, had the lockdowns of September and October washing through the system. We had, of course, big rises in labour market activity in both Victoria and New South Wales, of course, that they bore the brunt of the lockdown issue. So I guess we're sort of back to normal, although participation rates in New South Wales and Victoria still have just a smidgen to catch up with the levels they were in the middle of the year last year, and which means that there's still some upside there. But of course, the real elephant in the room, Michael, is what's going to happen to our labour markets as a result of what's been occurring late December and into January, with sadly this next wave of coronavirus infections certainly will affect the economy, hopefully in the short term. But that data is logically set to ease, the labour market data ease, when we get the February and January results in the next month or two. So there won't be quite as much high-fiving amongst those who are predicting an imminent rise, it seems, in official interest rates. However, Michael, we do have other factors that are part of that interest rate equation. And this week we will see the release of the December quarter inflation numbers. They will be higher. The annual numbers will rise. We're still seeing the key factors that drove higher inflation over the September quarter as a significant part of the economy and higher prices, and that is particularly the price of oil. We can see that the petrol prices are now pushing up towards $2 a litre, Michael. That's a significant factor in inflation, of course. The other factor that was part of that surge that was recorded over the September quarter are house building costs, and they still will be higher, particularly higher on those year-to-year quarterly comparisons. And of course, we're also seeing higher rental costs as part of that rise in inflation. So in my opinion, the inflation number to be released this week for the December quarter will be higher. Of course, that will add to the spinning eyes of those that are predicting higher interest rates as early as the middle of this year. But of course, the one thing we are forgetting, and perhaps those so-called analysts are forgetting, is that it's not about jobs, it's not about prices, it's actually about wages. And next week, we will see the release of the December quarter wages data. And I think it's highly unlikely that we will see a surge in wages growth comparable to inflation over the December quarter. Australia is, unlike the US, has a very sticky environment in terms of wage setting, and we were back up over 2% in the latest wage increase data for the September quarter, but that's still well behind the 3% plus levels we were getting a decade ago when we last increased interest rates. And of course, with likely to be another modest increase in wages growth over the December quarter, we then have to wait for the impact of the March quarter, which will include, of course, the issues with COVID over January and hopefully not much over February to work its way into wages growth. So really, predictions of an increase in August are just silly, Michael, because the Reserve Bank will not have the data for the June quarter until after its August meeting, likely. And it has consistently said that it needs to have a long series, or certainly an established series, of higher wages before it acts on official interest rates. And it is quite clearly said that not only does it need a longer term series of higher wages for it to act, but it's clearly said that it's prepared to be patient until that occurs. Certainly, that's just completely mind-boggling to expect the Reserve Bank to be raising interest rates in its first meeting in August when it still wouldn't have the data, which would be up the first post-COVID quarterly data, to see if wages growth had increased, much less to have the longer-term series that it would require. So I think the Reserve Bank, regardless of what happens with inflation and the jobs market, will still be comfortable with its predictions, and it will be waiting to see what happens with wages, because, Michael, wages growth is the key. And we are going to see a lot more headlines in the next week or so in regard to what I believe will be another spike in inflation and more really silly predictions about imminent interest rate increases.
Well, I think the other thing that's going to hit the headlines is our property markets are going to start with a bang again as people come out of their holiday mode. Our property markets slowed down from the extraordinary growth at the end of last year. But Andrew, there still seems to be significant momentum left. So 2022 promises to be another good year, even though the rate of acceleration of property price growth is likely to be lower.
Well, listing numbers have started off quite nicely this year, Michael, of course, compared to last year. But last year we were really, particularly in Sydney, in the midst, and then developing in Melbourne in the midst of lockdown scenarios, and a lot of concern about the direction of the virus at that time. So it is to be expected we'd have higher listings this year. It has started quite positively. So, sellers are happy to engage the market. The sales numbers are down a little bit, but they tend to lag those listing numbers. But I think we're going to see a slower market this year, Michael. A lot of that catch-up energy has dissipated. That was what was responsible for higher prices last year, was all the interruptions we'd had over previous years had improved affordability, and buyers took advantage of that and really pushed affordability back up to its maximum levels. That's why we saw prices growth declining, and we saw fewer buyers in the market because they bought. They don't buy every week. Underlying demand had been satisfied, but markets are still quite energetic going forward. But I do expect a normalisation of our housing markets this year, and that means prices growth in that sort of 5 to 7% bracket, depending on local factors. One thing we have forgotten, Michael, when we're discussing the housing market, not so much the housing market, but more interest rates, is we have an election coming up this year.
Yes, Michael. Definitely. And that's going to put a stall to the market for a while, isn't it?
Well, the commentators seem to have forgotten that, and that always acts as a handbrake to economic activity in the shorter term and to the housing market. I'm not sure there'll be any of the sort of policy positions that we had in the last election. Of course, if we remember that, it was notorious for those new policies proposed by the Labor Party to alter negative gearing and the discount for capital gains tax. And that, of course, has now been abandoned, predictably by the Labor Party. So there's no real negatives going forward for the property sector on the horizon from the election, but there is always that sense of uncertainty, particularly given tight polls, the prospect perhaps of a change in government, Michael, will have some buyers and sellers a little wary in the housing market, and also that'll act to make the economy a little circumspect about the future. So that's another, I guess, uncertainty that will work its way into, perhaps interest rate decisions going forward. So it will be an interesting year in that sense. However, just speaking about the election, Michael, I do think there'll be some positives for the housing market, and we've already seen perhaps some indications of that, particularly in regard to first home buyers. I think both parties will offer more incentives for first home buyers, particularly given that first home buyer numbers are now starting to fall, still quite healthy, but it's always a good political play to appeal to the poor old first home buyer who's had a pretty good go of it over the last couple of years nonetheless, but certainly finding it a lot tougher now. So I don't expect the election to have the same sort of significance on the housing market as it did during the last election, but nonetheless, it will create some uncertainty.
Well, affordability issues will constrain some first home buyers, but I see that also creating a bit of a two-tier property market, because the impetus of low interest rates has allowed people to borrow more and push property values up 20%, even 30% in some areas, but wages haven't gone up anywhere near as much as that, Andrew. So the higher end of the market can still often afford to buy properties at this stage of the cycle because they've got multiple sources of income. Their businesses share dividends, and their properties have gone up in value. But the lower end of the market probably is going to struggle a little bit more this year.
Well, we haven't mentioned migration either as a factor, Michael.
No.
Some of these analysts tend to forget. If all goes well according to their predictions and the economy starts to move into top gear, of course, we will get a rush from government to re-engage international migrants. And we're already seeing that there's plans set in motion now for 200,000 visas. Now, as soon as we get those borders opened, we'll create more competition for labour. Those 200,000 will be looking for jobs. And of course, that will put downward pressure on wages. Hello.
So keeps coming back to the same discussion, doesn't it, Andrew?
It does. And then again, the missing link is certainly wages growth. And if we do have a recovery, if COVID doesn't raise its ugly head again, and we've certainly got our fingers and toes crossed for that one, then we will have higher levels of migration. Both parties are committed to that, which will increase demand for housing, and it will also obviously increase demand for jobs as well. And that will put downward pressure on wages growth, but it will put upward pressure on prices, Michael.
Well, while 2021 was a year of upward pressure on prices, I see 2022 as being the year that rents are going to increase significantly, particularly for houses, especially if we're getting a lot more migrants and workers coming in, because there's a real shortage of apartments and houses.
Well, rents have been rising for the best part of a year, Michael, and now those increases have really consolidated. And I'm a firm believer that this is the law of supply and demand at work. There are lags, of course, in rental market supply, but we have a chronic shortage of rental properties in Australia now in most capital cities, particularly houses. And I believe that's a clear result of the actions of APRA, the financial regulator, way back in 15, 16, and then again in 17, 18, to restrict investor activity by creating an investor credit squeeze. And that, of course, has reduced the number of investors and the number of investor properties in the marketplace. And now the poor old tenant is paying the price for that, with rents going through the roof. And I think we're on the verge of almost a social crisis in terms of rental accommodation, because it's not going to get any better anytime soon. And I really think, APRA needs to be very circumspect about any future policies directed at investors, knowing that these are the consequences. It can have economy-wide implications, which it does have now. And interesting to see, given investor activity is certainly on the rise, whether there will be any actions this year from the financial regulator. Again, it does raise that very big question do the banks have too much market power? And is it a negative for the economy if they exercise that market power injudiciously, even through its financial regulator, APRA?
Andrew, I can see that this is also going to be a year of a flight to quality. Look, over the last year or two, especially last year, FOMO, fear of missing out, led many emotional home buyers and some inexperienced investors to purchase, well, almost any property their budget would allow. They just wanted to get in the market. And many were fortunate because that rising tide lifted all ships. But now, as our markets are maturing, I think we could see a flight to quality because there's going to be more stock, less pent-up demand, as you say. So well-located A-grade homes and investment-grade properties are still going to sell well, but secondary properties, they may have a bit of trouble finding a buyer.
Well, I still think our underlying energy in housing market activity is a lack of stock generally. Again, just reflecting on those APRA actions, we've underbuilt over the last 5 or 6 years. And if it hadn't have been for COVID and the shutting of international borders, I think we would be looking at a significant housing shortage in this country. I think it will emerge once we get back to normal, fingers crossed, because we just don't build enough houses anymore. We haven't been building enough houses or units for the last 4 or 5 years, and it's only been circumstances, and these things do take time to work their way into issues such as higher rents or prices. But I think that that's the next wave, Michael, is that we're going to start running out of properties, and particularly once we see international borders opened up again. And it's not just going to be the usual system of migrants that we had. We're going to go from 0 to 200,000 just like that. So that's a surge in demand, which will put a lot of strain on, particularly on our housing markets, which are already highly priced given what's happened over the last year or so in catch-up mode, particularly Melbourne and Sydney. And rents are also, as you mentioned, going through the roof. And we've got plenty of upside in smaller markets or more affordable markets, particularly Brisbane and Adelaide.
Definitely, those two states, the capital cities, are doing really well and are likely to continue. Andrew, just on availability of stock of new houses, a lot of people are forgetting that all those houses being built at the moment, there's all the news about home builder working so well, they're all pre-committed. There's very little speculative house activity, and the apartment market, well, there are very few new projects in the pipeline.
Well, that's absolutely right, Michael. I mean, it's not adding to the stock of housing per se as a speculative stock. It's all order job. And so there's already a buyer there for those properties. There's already an owner. So it's not easing our underlying issues with supply. But we've had a complete collapse in the apartment market since those APRA actions of 15, 16. And even though apartment development is starting to re-energise, it's coming from a very, very low base. And it is mainly the Sydney market where we are seeing a bit of a pickup in apartment approvals, but still, at a very low level compared to, where we were 4 or 5 years ago.
Another trend I see happening in 2022 is more property investors will return to the market. So far, the property cycle has been in particular driven by owner-occupiers and first home buyers because of the grants that we're talking about. But as the year finished off last year, we saw more investors come into the market.
Well, investors have been really the big story over the past year, Michael. We've seen investors' activity surging. No surprise, of course. Higher prices, capital gains, the prospect of capital gains attracts investors. I also think that the banks finally sort of woke up to the fact that they were missing out on business by curtailing lending to investors. I think there's been a much more realistic attitude towards investor lending from the banks. But having said all that, and investors have risen over 14 consecutive months, investor lending, I think that even with that surge in investor lending, investor market share is still below long-term average levels, Michael. So you're absolutely right. There's plenty of upside there because market share is still below the long-term average. And that's just another reflection of just how low investor activity was given that questionable credit squeeze that was placed on them. So plenty of appetite for investors to come into the market, particularly, Michael, with rents going through the roof. It means that it's holding up even with higher prices. So it's almost a perfect storm for investors with higher prices and higher rents. going forward. And that's the outlook is for even more demand, particularly from immigration levels rising.
I guess another thing that's going to happen this year is APRA is going to be watching our market carefully. But Andrew, I hope they remembered or learned the lessons from their past mistakes. Remember that under their watch, as you've said a couple of times already, the stricter bank lending criteria, it actually created a credit squeeze, didn't it?
Well, it did, Michael, and APRA always, I guess their statement is, well, we're only here to manage risk for the banks. And you can't argue with having a highly risk-averse banking system.
Yep.
The problem is that with so much market power in the banking system, that these actions can have wider spread economic consequences, which we're seeing now. And I think this is where governments have a responsibility to act. They just can't allow APRA and the banks to operate willy-nilly. Because it can have significant long-term effects on the economy and consumers. And I think banks, given their market power, have a clear responsibility to consumers. And if they, or APRA as their risk management tool, say, well, we don't have anything to do with the economy, I think then we need to ask government what's going on here. Do we need a more competitive banking system to stop these imbalances starting to rise in the banking sector? And all these predictions of higher interest rates from the banks sooner rather than later, which seem to come every week, always also tend to end up with a wave of refinancing occurring because people are worried about these predictions from the banks that interest rates are going to rise. So therefore they work to lock in fixed term rates over the shorter term. I'm asking, is this a strategy from the banks to create that energy that increases refinancing numbers? Because the latest loan data for November, Michael, showed another surge in refinancing over that month. And of course, if we look back to November, there was a lot of speculation again that interest rates were going to rise sooner rather than later. And consumers have sort of bought into that argument and locked in fixed term rates and or refinanced their product. And of course, banks are quite happy for that because it's a fee-based service to change your mortgage. And of course, when your mortgage loan expires, you've then got to find another one and pay more fees to do that. So again, this reflects that market power that the banks exercise. Is it in the interest of consumers? We know banks are struggling. That's a funny term, isn't it? Struggling with very low margins, historically low margins with these very low interest rates. But again, the government has a responsibility to ensure that the banks have the general interests of consumers at heart, given the strength of their market power and as it's exercised through APRA as well. So let's hope APRA don't act. And if they do act, maybe there's a conversation that needs to be started in regard to the banking sector's market power.
Well, there's some interesting thoughts there. I'd also just like to finish off talking a bit about what your thoughts for the economy are for 2022. After the prolonged lockdowns, it looked like we were opening up at the end of last year. Households had squirreled away an estimated $200 billion that we were hoping was going to be spent and grease the wheels of industry. And now there have been some self-imposed lockdowns. If you walk the streets in the months of January, the streets were empty, the shops were, some of the shops were closed, a lot of the restaurants were closed. So what do you see happening to our economy moving forward?
I think one of the interesting consequences from what's happened over the last 2 years, Michael, is I think we now have a cultural shift to work from home.
Yep.
What's going to happen in our CBD office markets will be interesting because I think now, as I said, it's almost a permanent shift to work from home. The CBDs in Melbourne and Sydney are empty at the moment. There's only a handful really of office workers returning to work. Everybody's comfortable with work from home, employers, employees, it seems. But there are consequences for that for staff that are employed on the basis of having to be in that office, support staff. And of course, then there's the lease environments for office space in our big CBD office markets. How does that sort of pan out? But more migration will create more economic activity. Of course, it's on the one hand, more demand, but on the other hand, more supply. So it's that balancing act. But Australia has certainly committed itself and risen off high levels of migration. So that will continue. But we've just got to really hope that COVID is finished this time, Michael. That's probably a little speculative at the moment, but we've just got to keep our fingers crossed that we don't keep bumping into that. But I think now that the lockdown spectre is well and truly behind us, hopefully, really would take something, spectacularly disastrous to go back into lockdown in terms of another virus. So with that behind us, our economy has adapted to that, and certainly much better than most other economies, if not all other economies. It hopefully is a year of what we could call full recovery this year, Michael, but we're certainly going to start off in a strong position. The only issue is, and it will take some time, is for how long it will take to push higher inflation, higher prices through the system. These things are one-offs in a sense in terms of building costs, but I think in terms of rental costs and fuel costs, that's likely to continue for some time. So I think that's the real issue, is how long it'll take inflation work itself through the economy, and the impact that will have on consumers.
I guess there's also the supply chain issues, which are creating some increasing costs.
Well, yeah, but they're short-term issues, Michael.
Yeah.
This hopefully will be the year. And what I meant by full recovery is that we get everything back to where it was, because we've resettled our economy. And that means removing all those supply roadblocks once we get everybody fully engaged. But a lot of people are sick at the moment, Michael, and not actively engaged, and that's where a lot of the supply constraints are affecting us. But at this moment, it looks like we're reaching a peak in terms of infections and hospitalisations. We're saying this with a lot of hope, of course. So the outlook and experience of the UK is certainly a positive as well, because their infections are falling quite dramatically. So we've just got to hope that trend continues. And when we speak in a month's time, we can be a lot more certain about what the future is then.
Well, clearly last year and the last couple of years were ones a lot of us would like to forget, but that won't be easy. So I agree with you. Let's hope 2022 is going to be a year we're going to want to remember. And I look forward to catching up with you each week in these Property Insider Chats, Andrew.
Thank you, Michael.